So they don't want to use the central bank balance sheet as much if they can avoid it. And the reason being is it's a very blunt tool because it just debases the denominator, but doesn't allow for the flow of funds into the economy. And what they've said very clearly, and the changes to the SLR is all about this, is you're better off to run it through the banking system and let them provide the liquidity, because then it goes via lending. If you think about the great game being played with AI, there's no way governments can do this. They can't afford it. So it has to come from leverage from the banking system. And that's what's going to happen. And if you look what happened in Japan, they've made exactly the same change.
A lot of fear, uncertainty, and doubt continue to hang over the global markets, spurred by a number of disturbing factors, particularly the US-Iran war and the resulting oil shock caused by Iran's blockade of the Strait of Hormuz. The cryptocurrency market is once again at the receiving end of the turmoil, with Bitcoin tumbling to the mid-60s on Friday. Altcoins are experiencing even sharper drops, and many fear the weekend will bring more volatility and uncertainty to the embattled crypto market. While crypto investors are no strangers to such sharp drops, many had higher hopes for 2026, with some even believing the year would deliver the euphoric tops they had awaited in futility in 2025. Whether that will eventually happen remains to be seen, but what is most certain at the moment is the despondency and low sentiment plaguing the crypto market. Nothing seems to be going the way many hoped and envisioned. Even the stablecoin yield battle is all but lost. The corrupt banking cabal has won yet another battle in the ongoing war with the crypto industry, and all we received was a small cold comfort. And this is despite having a pro-crypto president, regulators who are actually striving to understand what crypto is and to provide clear, favorable rules, and multi-billion-dollar institutions like BlackRock and MicroStrategy buying Bitcoin. Now the question on everyone's lips is, where do we go from here? What's actually next for crypto? Cold, hard, biting months of winter. Early spring, as soon as these uncertainties begin to clear up. Or an actual boom if liquidity conditions improve vastly later this year. Real Vision CEO Raoul Pal believes what's coming will not only be shocking, but also completely surpass the low expectations of most crypto investors. Pal's arguments are simple and straightforward. Governments and central banks cannot afford to let the current environment fester for too long, or else everything descends into complete chaos. Pal believes not only will these uncertainties be cleared soon, but help is coming, and Bitcoin will benefit massively when it begins. In today's video, we bring you clips from Pal's latest interview with Forward Guidance. Please share and like this video, subscribe to the channel, and turn on post notifications for more deep dives like this. Most importantly, ensure you watch to the end so you don't miss any part of Pal's insightful framework. Thanks, and enjoy the video. Buy $10,000 of Bitcoin on a regular exchange. It grows to $60,000. That $50,000 profit? You could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth? Tax-free. You keep the full $50,000. Same crypto. Completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing. Every time.
I think we all know that once the rate of change of oil goes to 100% year on year, we pretty much always had a recession. I don't think recessions are possible anymore. So my thesis is there's no recessions, but we'd have a huge slowdown. And then we've got the problem with rates going up again, and they've got to refinance all these debts. It becomes really ugly, which we saw back in 2022. So I think everybody's aware of it.
Yeah.
But I think market participants are scarred by 2022 because there was nowhere to hide. And so I think we're all looking at that thinking, oh my God, is this going to happen again? And we underestimating it like we did with Russia-Ukraine. But Russia-Ukraine was very different because it came on the back of COVID, and you had the reopening of factories, but no supply, but demand came back full. So what you had, this mismatch, same after World War II, you had this huge mismatch of people coming back into the workforce and the labor force, but the factories weren't able to produce anything. So the clearing thing is higher prices. And then you add in a nice energy crisis in the middle of it and a food crisis in the middle of it. We haven't got all of that here. So again, I'm watching it, and assuming that Iran doesn't want to get to the end game of this, the US doesn't want to. I mean, nobody really wants to have a full-on, boots on the ground, grinding warfare like Russia-Ukraine. So we can't let the collateral fall.
Yeah.
Once you understand that, you understand what they discovered in 2008 is when you print money, you lower the denominator and the price of collateral goes up. That's why the world recovered after 2008. And so they've learnt that one trick, is liquidity trumps everything. So the moment you start to have problems, i.e., let's say the S&P starts falling more than 25%, well, what happens? Immediately liquidity comes back. And when liquidity comes back, you lower the denominator, the asset prices go. Recessions normally happen when the collateral starts falling and everyone starts calling on it. But they don't allow that to happen. In a very indebted world, the best way is avoid the huge collapse by debasing currency 8% a year. It's a put option, basically, that we all pay for the system not to implode. Okay. So they've told you what they're going to do, and Steve Mirren made it super clear. So they don't want to use the central bank balance sheet as much if they can avoid it. And the reason being is it's a very blunt tool because it just debases the denominator, but doesn't allow for the flow of funds into the economy. And what they've said very clearly, and the changes to the ESLR is all about this, is you're better off to run it through the banking system and let them provide the liquidity, because then it goes via lending. If you think about the great game being played with AI, there's no way governments can do this. They can't afford it. So it has to come from leverage from the banking system. And that's what's going to happen. And if you look what happened in Japan, they've made exactly the same change. They've started shifting, igniting the banking system, having a steeper yield curve to start allowing lending again, because the Japanese banks haven't lent for 30 years, but they're going to start lending again because Japan also knows that with the aging demographics and all of the issues that are there, the government can't fund what needs to happen because, Japan is kind of the robotic side of the equation, the automation side of the equation. It's going to have to be funded by the private sector. So there's no way, we can't just tap the Middle East for cash all the time. They don't have infinite resources either. If you think about it, somebody like Mubadala have like $300 billion. It's not that much, not in the scale of what's needed here. We need trillions and trillions of dollars. So we're going to do, and again, I think it was Scott Bessent who said it again, basically they want to rerun the late 90s. Which is the Greenspan era. And what did Greenspan do? He came in, basically by the mid-90s, figured out what it was, cut rates, and then did nothing. He didn't do anything. And the banking system levered up. And so they provided the liquidity, and productivity kept inflation low. So he didn't have to do anything. So I think that's Walsh's job, is to cut rates and then get out of the way and let the banks do it. So the ESLR changes allow that. So that's a start where they can take directly, the Treasury can issue to the banks. And then I think they're going to try and push through the removal of the ESLR entirely, which is what they did over COVID.
Right.
And that allows the banking system to lever up.
What Raoul Pal is laying out here isn't just a defense of the system. It's an explanation of how the game has fundamentally changed since 2008. Policymakers learned a hard lesson during the 2008 financial crisis. When collateral collapses, everything collapses with it. And since then, the response mechanism has become almost automatic. Liquidity is no longer optional, it's the backstop. So even when markets wobble, even when oil shocks hit, even when bond markets begin to crack under pressure, intervention isn't a question of if, but when. That's why Pal argues that what we're seeing now isn't the setup for a traditional recession, but something more controlled, a slowdown that forces action. Because the alternative, a full-scale unwind of global debt and collateral, simply isn't something governments or central banks can afford to allow. And this is where the narrative begins to shift in a way most investors are still underestimating. Because while everyone is focused on rates, oil, and macro uncertainty, a much larger structural transformation is quietly accelerating beneath the surface. The liquidity that Pal expects to return doesn't just stabilize markets, it fuels the next phase of growth. And that growth, according to Pal, won't be driven by institutions alone, but by something far bigger. A new economic layer powered by artificial intelligence, digital ownership, and decentralized rails. In other words, while the market is distracted by fear, the foundation for crypto's most explosive narrative yet is already being built.
I realized recently, we all kind of knew the agents are going to use crypto rails, right?
Mm-hmm.
And we kind of left it at that. And I woke up one morning, I thought, the TAM of everything has gone to infinity. Right? We think about TAM being, okay, what's the TAM of the internet?
Yeah.
Maybe there's 6 billion people using the internet in the world today. So therefore, that's the TAM of anything. And there's 8.5 billion humans. But there's going to be 8.5 billion AI agents, maybe doing microtransactions. So then you think, oh, the TAM of crypto, I'm wildly wrong. I'm wildly wrong on this by orders of magnitude. And I realize that this is the strongest narrative we will ever have. It's more than the institutions are coming. It's the agents are coming, and they're coming in gigantic size. So I think it's much bigger than we expected. And then obviously the duality of that is digital ID has to come.
Right.
And trust within an agentic world. So I think the use case of blockchain just accelerates from here. And so I don't think it's a forced narrative whatsoever. I think it is going to be the narrative. And we all underestimate it. So firstly, let's go to the finance thing.
Yeah.
Payments, right? Everyone stops at that.
Yeah.
And thinks stable coins. Well, the US dollar doesn't really divide lower than 1 cent. They're going to use infinite number of different cryptocurrencies, tokens, or whatever. So that's one thing. So then agents who are doing economic activity will end up running a treasury because they'll be executing in Solana and Ethereum and Sui and whatever it is, right? And they'll have all this stuff, and they might be using Tau for compute. So they're going to be running treasuries. And they will be instantly using DeFi rails to manage treasuries and figuring out what is the best asset allocation. Okay, so that's kind of interesting. The whole investment management business is going to wildly change, because if you think of a business like Millennium in the hedge fund world, Millennium is a bunch of pods that used to be external hedge funds but now internal because of the economics of the industry. So they coalesce all of these talent together, and then they have this big mothership that has to figure out compliance and investors and capital allocation and accounting and all of that, risk and all of that stuff. All of those pods can be agents or individuals, because you can tokenize individuals. So it kind of collapses the entire cost base of that, the asset managers. And then you go to the mothership, all of that can go down to an algorithm. Okay, that is really disruptive for everybody from Fidelity through to every hedge fund in the world. So that's all going to change. So how we manage money, the system of that, the capital raising system. I always said that meme coins were instantaneous capital formation. And that's how agents or individuals will raise.
It's kind of the V0 prototype of it in a way.
Yeah. And so, okay, so we got all of that.
Yeah. And
then within that, we're thinking, okay, Ribbit Capital wrote that article about tokenization. Really important article. And Mickey Malka sent it to me beforehand, and I wrote a big article in GMI about it, where I said, well, if you take it to its logical conclusion that all data is going to be converted into a token, and a token not crypto token, just think of it as packets of information that are movable, transferable. So all data becomes a token. We're going to have vast token marketplaces because the agents will need data. And as we move from AGI to ASI, you're going to need vast amounts of data. And we're only trained on the internet so far. And so that amount of data is all going to get tokenized, packets of information, and then tradable. So that's another gigantic marketplace we don't even think about, that's going to be invisible to all of us, because it's going to be agents doing it.
Right.
And it's going to be taking data from wherever. So I think that's all to come as well. And then if you think about the extension of that, what was Web3? Read, write, own your own data. Well, that fits in with that marketplace stuff. You know, can you sell your data back to advertising people? Can you do that kind of stuff? So I think that all comes as well. And then, you know, I've always looked at what is the offset to a lot of this stuff, because this pace of change is so fast that I got to the point where I got to the economic singularity where I'm like, I have no clue anymore. And anybody who says they do are lying, right?
Yeah.
And I thought, okay, well, what has persistent value for us? And I got to, obviously, human experiences, all of that stuff. I got to the two offsets to all of this were nature and culture. And that's why I started investing a lot in digital art, because digital art to me was capturing the culture of the internet through the most monumental change humanity's ever gone through, And these are the stories we tell ourselves, much like cave paintings are or Warhol is. And so I started collecting enormous amounts of digital art because, the digital world is the new world and it will have value. And nature's the other side of it, which is why you live outside Whistler and I live in the Cayman Islands. It's like, it's a big offset.
Yeah.
It's a big offset than being here in New York City, where it feels more, it's closer to the disruption and everything else.
Yeah, 100%.
So I think the whole of crypto fits into this perfectly in every way, shape or form. And if I'm right that it's units of intelligence per unit of energy, then we are going to release as much information to the intelligence as possible so it gets bigger. And the Chinese will force it, and the Americans will turn it into a capitalist methodology.
Yeah.
So marketplaces, all of that, but it just won't be us. It won't be market makers and Jane Street running it. It's just not going to work like that.
War, rising oil prices, tightening financial conditions. These are real pressures, and they're clearly weighing on sentiment. But beneath all of that, the structural forces driving this cycle haven't disappeared. In fact, they may be getting stronger. Because if Pal is right, then what we're experiencing now isn't the of the cycle, it's the tension before the release. The key insight is this: liquidity doesn't just return randomly, it returns when the system demands it. And right now, with debt levels stretched, refinancing pressures building, and global growth slowing, that demand is rising fast. Whether it comes through central banks or the banking system itself, the end result is the same: more liquidity. And historically, when liquidity expands, risk assets don't just recover, they move aggressively. That's the environment where Bitcoin and the broader crypto market tend to thrive. But this time, there's an added layer that didn't exist in previous cycles. The integration of AI and blockchain technology is creating an entirely new economic paradigm, one where machines transact, manage capital, and generate value at a scale we've never seen before. And if that plays out as Pal expects, the total addressable market for crypto doesn't just grow, it explodes. Not incrementally, but exponentially. And that's the part of the story most investors are still missing. So the real question isn't whether the market feels uncertain right now. It clearly does. The question is whether you're positioning for what comes after. Because if Pal's thesis holds, the combination of returning liquidity and an expanding crypto use case could set the stage for a move that catches the majority off guard. One that doesn't just meet expectations, but completely resets them. If you found this breakdown valuable, make sure you like the video, subscribe to the channel, and turn on post notifications so you never miss these deep dives. Thanks for watching, and see you in the next one.